Hello and welcome again to Credit Versio's Q&A Wednesday live for September 21st. I'm your host, David Michalek. I'm a consumer credit expert with nearly 10 years of experience. In fact, next year it will be 10 years that I've been in this business. And in that time, I've conducted well over 10,000 one-on-one credit consultations. Our insurance companies, landlord, mortgage broker, banks, even our employers are looking at our credit report. And they want to see how we honor our obligations. And having great credit is critical because credit reports have become reputation reports. They become our adult report cards, and they tell the story of what you and I do when we are entrusted with credit. And that's some real talk right there. Those are real facts about where we are in the year 2022. And I was just thinking about this earlier today, and I've had this conversation a couple of times with some guys in the office. So I've done over 120 of these Wednesday live Q&As. Actually, it's this is 118 in Credit Versio, and then I've done 4 or 5 others in another private Facebook group. So well over 120 of these, and I want to tell you why I'm here every week. I'm sure that's, I'm not, I don't have, there's no subscription going on here. We don't monetize the videos. So I imagine sometimes people wonder, well, week in, week out, every Wednesday, you're always here either by yourself or with John, on occasion with somebody else. Why do you take the time to do this? And I want to tell you the story why. It's probably one of the most sobering stories when it comes to credit. So we got to go back a little ways. We got to go back to the year, I want to say it was 2020. No, I'm sorry. 2010, actually. Yeah, 2010. At the time. So we're going to go back. No, actually, we got to go back further than that. This is 2000. My goodness. See, when you get over 40, get into your 50s, sometimes these decades start getting a little hard to track. So we're going back to the year 2000. And at the time, I used to be the F&I manager over at Saturn. Remember Saturn back in the day, the GM company that we had for about 10 years, something like that. And I was relatively new to the position. So what my job was to manage all the sales people that were there and manage the finance side. So it was a pretty good size dealership. This was in Temecula in Southern California. And I was there for some time. I was with Saturn for a little while. And one of the things that I did is look at people's credit reports and try to get them approved for whatever it is they wanted to buy. Most of the time, of course, it was a Saturn because that was the dealership that I worked for. But we also had a pretty good sized used car lot as well. So ideally, what Saturn wanted at the time were people to get financed by GMAC, back when GMAC was around. And that would handle what we would call our A and our B paper. So everybody had good credit and relatively good credit. When you started getting out of that into your C and D paper, then you had all these other banks, these secondary paper, or secondary lenders that we would call them. And these were the banks that were willing to take on more risk. They were willing to take that client that had a much lower credit score or was otherwise a lot more of a risk. And during that time, that was sort of what the big project was, is when you had a client and you looked at the credit report. I didn't get a lot of details back in the day. I really couldn't see everything. I could see a little summary. We had a summary page and a score. And I'd have to go through my book. It was a physical book of all of the different secondary lenders that we'd have. And I'd have to go through their criteria. We want this, this, and this. We don't want this, this, and this. And we had probably 20, 30 banks that we worked with. So sometimes the challenge was looking at the card that they wanted to buy, how much they were putting down, what the value to loan was, and also income. There's a lot of things that we had to take a look at, and then we had to go look at the book to see if we had a lender or who would be the best lender to fit that buyer. So it's a little bit of an art, a little bit of a science. So I had this couple, great couple. I actually remember them very vividly. I really liked them a lot, and they went through some hard times. I can't remember if it was medical or whatever it was, but they went through some hard times. Their credit scores were really low. I don't know exactly what they were. It's been a long time. But I couldn't get any of the banks to buy them, except I had one person in my back pocket that I was very familiar with. Her name was Aida. And She would come in every Tuesday, and she would look at all of the paper that I had, all the loans that I had that I wasn't able to place, and most of the time she would take them. So this particular couple was very challenged. They had a lot of stuff on the credit report, but they'd recovered. They were doing okay now. So Aida comes into my office, and I remember this very vividly. And what happened here is the reason why I'm telling this story. So I sat down with her, and I said, listen, I got this couple. They're already in the car. They actually drove off the lot. I put them in the car like probably the week before, trying to get somebody to buy the loan for me, and nobody would do it. So here's Aida. She's my go-to girl, and I'm explaining to her, and I have all this documentation that the client had given me, like, well, this is what happened, and here's our paperwork, and this is how it was resolved. And I had it all ready to go, all in a nice binder. And Aida's sitting at my desk. I'm like, I got this couple, Mr. and Mrs., and let me tell you their story. And this is what happened. And I start flipping through pages, showing her all the information. She just puts her hand on my arm. She says, listen, David, I want to tell you something. She told me probably the 6 most important words I've ever heard when it comes down to credit. And one of the things I reflect on every now and then being in this business, and I'll put it up on the screen here. Here it is. She told me this: no bank is a story bank. Didn't matter. She didn't want to hear the story from the people. She didn't want me to convey to her the story of the couple that I had in my office. And the reason for that was, she said, the story is already there. Everything that I need to know about that buyer is right there on the credit report. I don't need their story. I need the story. And that was really sobering to me. So no bank is a story bank. The reason why credit reports have evolved into so much more than they've ever been is because they do tell a story. They tell a story of what you and I do. How do we handle our debt? How do we handle our financial responsibilities? Credit reports are so predictive of what we are likely to do based on everything that we've done in the past. Now, you could argue that's not necessarily fair, and under certain circumstances, I would agree with you. Do I think it takes 7 years to recover from a bad situation? Not really. I don't think so. Fortunately, that stuff doesn't do a tremendous amount of damage for the full 7 years, but it's there cosmetically. So that's why I'm here. I'm here to answer your questions about how credit works, about the dispute process, and of course, about Crediversio. So I see we've got a bunch of people that jumped on. Happy to have you. And the way that these work, my lives is what I'm referring to, is that I'm going to cover a topic or two. I'll go for maybe 30 minutes, maybe 45 minutes. Sometimes we go a little bit longer. And if you have a question, feel free to throw it at me. We don't have to be on topic. I like to talk about a couple of things that happened during the week, but if you want to change the subject, if you got something on your mind, if you're having some challenges, if there's something you don't understand, if you just want a straight answer, credit and credit repair is one of those industries that is full of so much garbage. I mean, I wish I could give you a magic pill that could give you some insight into this business. It's crazy. So that's why myself, John, who's on with me, and occasionally I have some other experts that are on with me that are here to explain this stuff to you. Okay, so feel free to jump in. Dee Dee says, hello, thanks for all that you do. You are very welcome. Thank you for being here. I appreciate it. I'm hoping this is a learning experience for everybody. And Hassan, how are you doing? Hassan, doing great. And what would make this even a better experience for all of us? Ask some great questions. No question's a dumb question. Believe me, I've seen it all. I've heard it all. It's been some time since I've seen something that I haven't seen dozens of times before. So feel free to ask away. Okay. So just like I said a second ago, every week when I get on, I like to bring up a subject. And usually it revolves around maybe a 1, 2, 3 posts that I got during the week. So I'm the one for the most part that manages our Facebook page, not so much the ad campaigns, but the interaction with the clients. And I do see some tickets on occasion as well. So I keep my finger on the pulse of what's going on with all the questions and interactions that we have. So anyway, Hassan says, I'm trying to see if you guys are the real deal. How do you define real deal? That's a very obscure, very subjective term, I think. But anyway, Ask a question, Hassan. Happy to answer for you. Okay, so the question is, and I got this a couple times this week, is, and this is one I've been answering for almost 10 years now, is don't I have a credit score? What is my credit score? What's my real credit score, David? I've got this credit score over here and this credit score over here. My bank app says my score is this. Credit Karma says my score is this. FICO says my score is this. So one of the things that is a little difficult for somebody to wrap their head around initially when you're just getting into understanding how credit works is the fact that we don't have one credit score. We literally have hundreds of credit scores. Credit scores, just so you understand, FICO came about in 1956. That's when FICO was invented, excuse me. And FICO's entire purpose was to provide predictive data for the lending industry. And fast forward, we have to go forward a few decades actually, before FICO became something that we're all familiar with. It wasn't until 1989 that the credit bureaus adopted their first FICO score. And even in that time, you and I didn't really have access to our credit reports. So we went decades with no real access to our credit report. All of that changed with FACTA. The FACTA is the Fair and Accurate Credit Transaction Act. That's how we got, that came about in 2003, and that's how we ended up getting annualcreditreport.com. That came from FACTA. Okay, that is a separate company that is owned by the three credit bureaus, and they are mandated to provide that. Now, there are no free. I mean, we're not promised a free credit score. Credit scores are those things that do cost money. Somebody's paying for it. If you go to annualcreditreport.com, you'll notice there's no score there. That's because FICO, which is a different company, was never ordered to provide a credit score. Same thing with VantageScore. That's also owned by the three bureaus. They were never charged with providing free credit scores to anybody. Although there's places you can get your credit score free no matter where you go. I mean, there's lots of places. Okay. So credit scores were really designed to predict risk. And there's a lot of different credit scores because there's a lot of different industries. So we really have two types of credit scores, or credit scores, I should say, fall under two categories. There's what's called generic, which is, say, like your FICO 8, your VantageScore 3, VantageScore 4. These are generic scores, meaning there's nothing, they're not specifically engineered for any type of lending. And then we have what are called industry-specific scores. Now, these are scores. Now, this is all FICO right here. VantageScore doesn't make an industry-specific score. That's just FICO. And FICO's been doing this for decades. And essentially what an industry-specific score is let's say I'm the mortgage industry. And I understand how important it is for my clientele to have the following metrics that we believe is representative of a good investment for a mortgage loan. Okay, we've been looking at markers, we've been looking at data for decades, and these are some things that we find important. So in this case, they went to FICO and said, listen, we want to have a scoring model that is very predictive of risk when it comes to borrowing money for a home. That's what the FICO Model 2, 4, and 5, the Beacon score, that's where that came from. That's why the mortgage industry still uses these really old and outdated scores. They've been around for decades. The auto industry has its own FICO score that's more sensitive to things that have to do with how you treat your auto loans. So, for example, maybe you go to buy a car and you've got some late payment in your credit card history, but nothing on your auto loan. So your auto loan would be less impacted, or excuse me, your auto FICO would be less impacted by those credit card late payments. Now, there's also credit card FICO scores. Actually, there's two of them. And there's an 8, and there's also I believe it's a 5 now. It might even be a 4. And those act differently. So if you're applying for a credit card, that lender is very likely going to use a FICO credit card score. They probably will also look at your Vantage score, but we'll get into that in a second. So the reason why you see different scores all over the place. Like if you go to myfico.com, you'll see a lot of different FICO scores for all kinds of industries. And there are scores that you'll never see. You probably will never see your auto insurance score. You probably won't see your rental insurance score, your homeowner's insurance score. So these are all scores that have been created to predict risk in certain specific industries. So that's why, I get this question all the time is, okay, but what's my real score? Well, they're all your real score. They're just slightly different. Okay, question from Dee Dee. How important is having a mortgage? My credit scores are fine, but my monitoring service keeps saying that a lack of a real estate account is hurting me. When I buy a house, will my score go up? That's certainly no reason to go out and buy a home, but one of the things that does tend to happen is a mortgage loan is a little more representative of risk. I mean, of better risk, because it takes a lot to get a mortgage loan. It's relative. I mean, it's based on income, and it's based on a handful of other things. But you have to have somewhat decent credit. It's not like the old days back in 2002, 3, 4, and 5, where you have the no money loans. What was it? No income, no assets. We had some crazy stuff back then, didn't we? So you have to. I mean, now to get a mortgage, you have to put a little bit something down. Even though there are some programs out there to eliminate a lot of the outlay for a home, it's still one of those loans that looks good on a credit report. Now, will your score go up? Maybe. I'll give you a great example. I just bought a house against my better judgment. That's a whole other story. But it actually made sense. I'm in Vegas, where renting was significantly, or not significantly, but I mean it's just like buying a home. In some cases, it's a lot more expensive to rent out here than it is to buy. So even though I realized I bought a little high, I don't plan on moving anytime soon, so that wasn't really all that important to me. I understand that real estate values are probably going to go down a little bit, but I still bought anyway, just for the stability, and my score really hasn't moved. So, but then again, my scores were already in the low 800s as they were. I didn't expect a big jump, didn't really need to. Are you going to see a jump in score if you buy a home, if you have a mortgage report? It's possible. It might take quite some time for that to take place, though. Because here's two things you have to take in consideration. One is you have a new loan now, so your average age of accounts has been affected by a brand new loan. So you've got that taking place. Whatever minimal effect that inquiry might have, and it doesn't matter if you got 2 or 5 or 10, as long as they happen within a 45-day period, those all count as one inquiry. So it's not like having a bunch of inquiries during the mortgage application process is going to hurt you at all. So it's a great question, Dee Dee. Theoretically, yes. I have seen that in the mix of credit. What FICO does like to see, they like to see an installment loan. They like to see a revolving account, and they do like to see a mortgage. Now, you don't have to have them all open. They just have to be there. That's one of the really important things that you have to understand, is that to get credit for this stuff, you don't have to have an open installment loan. If you have a paid car loan, you're still getting credit for having that one installment loan, even though it's not open anymore. Same thing with a mortgage. If the mortgage was still there. In fact, I saw a little bit of a drop in my score years ago when one of my mortgages ended up falling off. It was actually in fact, I had 2 of them that were satisfied mortgages for properties that I sold. And then eventually they dropped off because they were over 10 years old. They had been paid off. They were just sitting there. And I did see a little bit of a dip. But at that time, there was so much negative stuff on my credit report that it wasn't probably helping me all that much anyway. But great question. So we've got FICO, which, by the way, really interesting story about the FICO VantageScore relationship. There's a lot of confusion about VantageScore, and if this is you, if VantageScore is one of those things where you don't understand how relevant it is, if you have some confusion about VantageScore, if you had a question, feel free to ask it. That's what I'm here for. So I'll give you a little history on VantageScore because it's pretty interesting. So as you know, the bureaus have their data, Okay, there's Experian, Equifax, TransUnion. Okay, there's more bureaus than that, but these are referred to as the big three. And then you have FICO, which is a completely separate company. Okay, now the credit bureaus have the data. They own the data. Today they've got over 14, almost 15,000 data furnishers. These are creditors. These are entities that report information to the credit bureaus. They have a tremendous amount of information. They have credit files for over 200 million people. And there was a time when they had this data, but all they could do was supply it. And then you had this other third party named FICO that would make it all make sense, that would actually put a value on it. They're the ones that created the score. The bureaus don't create scores. Bureaus just provide the data. So depending on where that data is going, maybe it's a car dealership, maybe it's a mortgage broker, maybe you're trying to get auto insurance, a credit card, something like that. When they run your credit report and they get your report, when that score comes back, that score is taking place somewhere separate. It's a separate thing from the bureau itself. Now, granted, it's using the data from the bureau or bureaus, but it's software that sits separately from the information that's on the credit bureau. Now, what's fascinating about this is it wasn't until the early 2000s that the three bureaus, and by the way, these are three separate companies. They are competitors. They don't, unless they're mandated by law, they don't really talk to each other. They don't share data with each other. And they all got together, and then they asked each other, what would happen if we created our own score? I mean, let's entertain this, because we're the ones that have all the data. Why does anybody have to rely on this third party FICO to create a score if we can perhaps do the same thing? So they hired this outside company, and it was a consulting firm. And essentially what they asked of this company is, hey, what would happen if we offered a credit score? If we were the ones where it was a one-stop shop, we have the data, we provide the score. How much market value, or how much of the market can we capture from FICO? Because at the time it was just FICO. I mean, there are other little, quirky scoring models at the time, or scoring software at the time, but nothing like FICO. FICO essentially had, let's just call it 99.5% of the market. What the other half percentage, I can't tell you, but I know that there were others out there. The fact that I don't know who they are probably makes a pretty good statement that they weren't significant. So this consulting firm, after deliberating for a while, doing some research, comes back to the three credit bureaus and says, listen, you guys would capture 100% of the market. So that gets them excited. And that's where the story of VantageScore comes from. So they all create this separate company called VantageScore. Okay, they all have a vested interest in it. And it took them years to create the mathematical formulas, the algorithms that produce the VantageScore that we see today. Eventually, VantageScore was released in 2006. And to the surprise of everybody, years and years later, even to today, you want to know how much market they've captured? Well, it wasn't the 100% that this consulting company suggested. They didn't get 100%. They didn't get 90 or 80 or 50 or 30. They got about 10% of the market, even to this day. So what are we, 17 years later? Even to this day, they still have about 10, maybe 11% of the market. Now, that is growing, by the way, and it's growing pretty quickly. Vantage scores are used a lot, but they're usually used alongside of a FICO score. So Vantage score, we can make a very, very good argument, is just as relevant, not in some applications like mortgage, although that might change in the future. There is an argument. There are some actions taking place to pressure FHFA to give up the old FICO model and start allowing some competitive scores in there. So a lot of things are changing. VantageScore use is going through the roof. They're getting very, very popular, especially the last couple of years. Sage, good to see you. Welcome. Thank you for being here today. Okay, any questions on VantageScore? I love talking about this stuff because it has a fascinating history, And it's a history that affects all of us. Okay, so a couple of things about scores. First of all, one of the things I've always told people over the years is, don't obsess so much over something that changes from one month to the next. Okay, there's a lot you can do to improve your credit score. It's easy to go from, say, the mid 500s. I've been there. Okay, the mid 500s into the 700s. A lot of it is just good credit habits. And if you do just some smart things, it's not too difficult to get there. One of the biggest things that helps people get into these better credit scores, and we're not even talking about credit repair, is just paying down credit card debt. You have a tremendous amount of your score that is predicated on your credit card debt. Now, just give me a yes or a no. Let me know if this is something that you're aware of. Because one of the things that happens quite frequently when we see a customer service here, when we see big changes in credit score, drops in credit score, it's always a handful of things. Most of the time, it's the usage rate of a credit card going up substantially. That's usually it. I would say probably of all the tickets that we've gotten, all the questions I've had over the years, like I get calls even back before I was with Credit Versio, when I was really hands-on, when I was working with clients 6, 7, 8, 9, 10 hours every single day on the phone talking to clients. Hey, why did my score drop? Well, I already knew before I even picked up the phone that what the answer to that person's question was. So when they say, well, why did my score drop? Okay, well, let me take a look at your credit report. And usually, just like that, I can tell you, well, tell me about your credit card balances. What was it last month? What is it this month? Well, I've got a $300 limit on a secured credit card. I just got it. Last month, I had a $300 credit limit. I had all $300 available. And then after a couple of weeks, I went out, I went to a restaurant, spent $295, put it on the card, haven't paid it off yet. Well, there you go. So you're almost 100% utilized, and that explains why your score dropped 80 points. That's one of the most common conversations I've had. Okay, Sage asks a question. Are the Smart Credit Vantage scores the same as Credit Karma Vantage scores, or are they the same Vantage scores? Okay, yeah. So the answer to your question, yeah. So right now, pretty much everything that we see, if you go and get a Vantage score, I would say 95% chance you're going to see Vantage Score 3. So it's Vantage 3.0, Vantage Score 3.0. That's what we're seeing right now. Even though there is a 4.0, okay, I've seen it. It's not in great circulation right now. So anywhere you go that's going to show you a Vantage score, for the most part, you're going to see Vantage Score 3.0. But you know what? What is the most common FICO score that we see? It's 8. It's FICO Model 8. However, we've had a 9 for over a year. We've had a 10 and a 10T. Those were released, I think, I want to say 6 to 8 months ago. Might even be longer. So 10 and 10T, those are 10T. That's the trended scoring model. Same thing with Vantage Score 4.0. That's trended data. What that means is, and I'll try to explain this one as simply as I possibly can. What trended data looks for, like, have you ever had this issue? Like, let's just take the example I just gave you. Somebody has a credit card with a $300 credit limit, maxes it out. That $297 balance gets reported to the bureaus. Scores tank. Okay, that's not trended data. That's looking at what does the information say right now at this moment. So what does trended data mean? Okay, well, what if that person over time proves that they tend to pay that card off every month? Okay, yeah, so it got reported to the bureaus at that moment in time with a high balance, but a few days later from now, it's going to be paid off. And then he charges it all the way up again, then pays it off, charges it up again, pays it off. Doesn't make the minimum payment every month. So that's a different animal right there. Okay, that's a different thing altogether. What that means is this is somebody that, even though at that moment in time that balance was reported to the bureaus, which drop the score, this is somebody who is a transactor, not a revolver. Now, what's the difference between the two? Well, a revolver is somebody who charges the card up, usually makes some payments, a little bit, maybe minimum, a little bit above the minimum payment, but doesn't pay off the balance every month. So who's a better risk? The person who makes minimum payments that is just trying to keep the balance down a little bit on that card but not paying it off, versus the person that pays that card off every month. Okay, the better risk is that person who's paying that card off every month, because it's just a transaction for them. So with VantageScore 4.0, that observes trended data. It's looking at that information over 12 months, 24 months to see how you treat your credit card balances, how you treat your other balances. Now, the problem is it doesn't have wide adoption yet. I don't know when it will. FICO 10T is hands down the best, most predictive score that there is. It's most predictive and accurate for risk, but it's not in wide use. Same thing with Vantage 4.0. It's an incredible improvement over 3.0. So why is it not in use? Well, it takes a lot for any lending institution to change the way that they assess risk in their lenders, and they're not inclined to change stuff if they have a model that works. So when they get credit scores from both FICO, whether it's an industry-specific score or a generic score, or it's VantageScore 3, or both, and they take that data into their system and they compare it with their own metrics that assess risk, and they're like, these scores are great. Okay, they're serving us well. We don't need to change anything. Yeah, okay, so what? VantageScore 4.0 is better. Okay. FICO 10 and 10T, it would be better. But are we going to change up the entire system to accommodate a new model? It doesn't happen very often. I mean, that's why FHFA is using a 20-plus-year-old FICO model for mortgage lending. Now, granted, the government has imposed that upon them, and that should change. It's not FICO's fault. It's FHFA. But they've been so comfortable with that model for so long. And yeah, it's not a great model, actually. They'd be better served just having FICO Model 8, to be honest. VantageScore 3 would be more predictive and more reliable than the old FICO scores. Okay, they take so much more into consideration. That's more real-world stuff. Case in point, if you've been watching the live for a while, or if you've been following this for a while, one of the things that has changed recently is the way that FICO is going to treat, and also VantageScore too, how they're treating medical collections. One of the things that FICO was able to determine is that the presence of medical collections on a credit report is not predictive of risk. Okay, because you can have a lot of people who are paying their bills on time, they're doing great, and then there's some kind of a medical situation, and they're negotiating with their insurance company, and months go by. Okay, I've talked to a ton of people like this. And then next thing you know, there's this bill that they didn't account for that went to collections. Somehow it got missed. Does that mean that they don't pay their bills, or they wouldn't have honored the obligation? No. So would that be a better model to have for assessing risk for a mortgage than a 20-plus-year-old mortgage score that doesn't account for that? And anybody who does risk assessment would argue, yeah, it would be better to have a modern FICO score for that. Okay. Satoria, welcome. Good to see you again. Chef DeFlava, hello, welcome. All right. Hassan, question. Even if your credit card is almost maxed out and your credit score has been impacted because of it, how would getting your credit fix help score go up? Well, so Hassan, we're talking about two totally different things. Remember, a credit report is a thing that refreshes or it's new constantly. When you get a credit report and a score, that's a query. So when you get a credit report and a score, or when you order your credit report, there's no credit report in some file in the cloud waiting for you to order it. So, for example, if I were to get my credit report right now, if I were to order it, it's not just sitting there in somebody's file or in somebody's database waiting for me to get it. It's a query. So if I order a report, what happens is that request goes into, let's just say I'm going to Experian. Okay, well, it happens the same way with all three bureaus, but let's just use Experian. What happens is I put in all my information. Okay, first name, last name, middle name, Social Security, date of birth, address, all of my identifiable information. It's called PII, personal identifiable information. That's what the bureaus have on me. When I submit that, it goes into this massive pool of data. And it goes, oh, okay, David Michalek, this is all of his info. Okay, let's build his credit report right now. So what happens is it goes out into the Experian database and grabs all of my data that is relevant right at that very moment in time, as of that day. So if one of my creditors happened to have reported something yesterday, it'll be on that credit report. Now, at that moment, when that credit report comes back, whatever FICO model is being used to score it, or VantageScore model is being used to score it, that is my score at that moment in time. That credit report and that score can be different tomorrow. It can be different the next day. It's very likely to be different a couple of days later, depending on who's reporting data to my credit report and what factual change that makes. So in your example, Hassan, well, what if I get a credit report on Monday and my score is, let's just say it's 650. And then the next Monday, because I've paid my credit card balance off, my credit card issuer reflects that zero balance on that next credit report that next Monday. And my score shoots up because my balance is now lower. Now, this is assuming that effect would take place. So when would it not take place? Well, let's just say I had 20 collections on my account, and my account isn't as sensitive to credit card balances because I've got so much derogatory stuff. But most of the time, if I'm paying off a credit card, I'm going to see an increase in my score. Now, the second part of your question, or the back part of it, which is how will fixing credit help? Well, that's a completely separate thing. Here we're talking about the dispute and potentially removal of information that might be derogatory. And still, you have to be careful with that too. Like I see people, unfortunately, that they'll dispute a 6.5-year-old charge-off. But that charge-off, that account has been on their credit report and giving them good positive or good age for 15 years. And they delete that, and then it falls off. It wasn't hurting them much to begin with because it was so old, but they lost all that history. Now, that's a rare thing. Okay, I just wanted to point out that just because you delete something from a credit report that's derogatory doesn't necessarily mean it's going to help. So what most people are doing in the credit repair process is they are challenging any account they can, which, by the way, nothing wrong with that. If you've got 25 derogatory accounts on your credit report and you want to challenge all 25 of them, have at it. There's nothing anywhere, nowhere in the Fair Credit Reporting Act, nowhere does it say you can't do that. You have the legal right to dispute, question anything you want on your credit report. The burden of proof, the burden of performance in the FCRA is on the Bureau and the data furnisher. They have to do what's called a reasonable investigation. That's the language right out of the Fair Credit Reporting Act. And truth be told, I've been doing this a long time. I can't tell you how many millions of disputes that I've done, even before I came to Crediversio. And Crediversio probably does more disputes than Lexington Law because there's a lot more people using it. It's a DIY. It doesn't cost anything except for the subscription of your bureau, and it does a better job than people at reading your credit report and coming up with dispute reasons. So, you have that legal right to do that. Now, sometimes, when you send off a dispute, truth be told, what happens most of the time when things get deleted is they're just not verifiable. Okay, they could be wrong. But a lot of times people, when they look at their own credit reports, are not necessarily sure if something's wrong or not. That's why the algorithms in Crediversio are so good, because they're looking for problems between the three bureaus on a single account, and then going back and comparing last month's credit report and the credit report before that. But if you're just doing it on your own, say you're not using Credit Versio, that's fine. Or you've hired somebody to fix your credit, that's perfectly fine. You can dispute and challenge anything you want. Just try to make the dispute relevant to what's on the credit report. And fingers crossed it gets deleted because it's not verifiable, or there's some kind of error somewhere that maybe you didn't see, but the data furnisher sees and is not able to correct. So there's 4 reasons why things get removed from credit reports. Either they're erroneous, outdated, incomplete, or unverifiable. So it's the first 2. Erroneous means just wrong. Okay, outdated, I see that every now and then. Incomplete happens, or unverifiable. That's the thing that is the hardest to do for a data furnisher, is to go back and verify. And it's your legal right. Hey, I don't know if this information is correct. I don't know if these late payments are correct. Can you verify it for me? Okay, it's easy dispute. Okay. Sage, really appreciate you doing these lives, brother. You are very welcome, Sage. Glad you're here. Is it Jaman? I took a stab at it. Sorry if I mispronounced it. I hired someone to repair my credit, but got no results. So I decided to try to do it myself with you. I don't know what he was putting in the letters he was sending. Do I still start from dispute letter 1? Awesome question. Love that question. Okay. So I'll just say Jamin and ask your forgiveness if that's wrong. Okay, so there's a couple things going on here. Number 1, I want to show you something. This is called Exception G, or we call it Section G. Exclusion of credit repair organizations. Okay, I just want to hold this up here. Let me move it a little bit. And I want to explain this to you because this is a big, big deal. And this is happening more and more. Okay, in the Fair Credit Reporting Act, it does a really good job of outlining what credit bureaus and data furnishers need to do when they receive a dispute. And it's complex. I mean, they have to do a lot when they receive a dispute. Now, in the Fair Credit Reporting Act, when it goes through this whole litany of everything that they have to do, then at the very end of it, there's this section right here. G, exclusion of credit repair organizations. It says, this paragraph shall not apply. This is the paragraph that explains what they have to do. Shall not apply if the notice of dispute, this is your dispute letter, whether it's online or paper, is submitted by, is prepared on behalf of the consumer by, or is submitted on a form supplied to the consumer by a credit repair organization is defined in section 4033. Well, what does that mean? It means that if your dispute, so Jamin, if you hire somebody to fix your credit and they send a dispute letter for you, and if it's not a law firm that has a power of attorney, or if it's not a credit repair company that has a power of attorney, then the bureau can just say, no, we're not going to handle this. The law gives us the right to ignore it. Now, I'm not saying that's what happened, but it happens a lot. TransUnion and Equifax, especially TransUnion, are huge on sending back letters saying, this did not come from you. And they will cite the reason why they are not going to conduct a reasonable investigation, because they don't have to. Okay. Do you start from letter 1? Yes. Start all over again, because these are coming from you. Now, the bureaus know, by the way, the bureaus know that these disputes are either coming from a credit repair company or coming from you. How do they know that? There's a handful of reasons, but the easiest one is the postmark doesn't match. So if I'm here in Las Vegas, Nevada. If I live in Las Vegas, and let's just say I'm a guy that hired a credit repair company, I need some help. I hire ABC company. Let's say I hire Lexington Law. I'm not picking on Lexington Law. Everybody knows who Lexington Law is. And they send a dispute letter out for me. And let's say it comes from Salt Lake City. I think they have mailing places all over the place, but let's just say they send it from Salt Lake City. So the bureaus are going to see that indicia, that postmark, is coming from Salt Lake City, but yet I live in Las Vegas. They can tell it wasn't done by me. There's a handful of other things too. And I know this because one of our very good partners, actually 2 of them, used to work in dispute resolution, one for TransUnion and one for Equifax. So we have a pretty intimate knowledge of what goes on behind the scenes in a credit bureau from these 2 guys. Okay, so great question. Love the question. All right, William. Almost made the mistake of disputing for removal of one of the 6-year-old charge-offs. Thanks for the language in my dispute letter. I was asking the account to be updated with the balance being reported as 0 instead. Currently being investigated. Fingers crossed. Good job, William. Yeah. Here's the thing, and let me just parrot something that excuse me. Let me just parrot something that John Alzheimer, who's been on with me, oh God, probably 50, 60 times, has said. And this is a guy that, now I'm a certified FICO pro. I'm a FICO instructor, so I can explain how FICO works. I can teach FICO. John used to work for FICO, and he is this guy's a wealth of knowledge, and he was one of my early mentors, and still is a mentor of mine. And one of the things that you hear us both talk about, and this is something that John talks about all the time, is that when you have derogatory credit, you recover from that largely within 24 months. Okay, your credit score is a prediction of the likelihood that you're going to go in or have a major default in the next 24 months. Okay, scores are all about 24 months. A lot of it's about what's going to happen in the next 24 months. So William, to answer, to just finish addressing your post, if you've got a 6-year-old charge-off, you've largely recovered from that. I mean, yes, it's still there cosmetically. Yes, it might play, it might move you into a certain risk bucket, but it's not doing the damage that it did when you first got it. Oh, excuse me, 1 second. I need to reach over and grab this. Okay, thank you. All right. Let's see. Sage, I'm on round 2. First round took off college debt. Okay, that's great. Listen, here's my stance on credit repair, and which, by the way, has changed a little bit over the years. I think that I went through the credit repair process myself. That's how I got into this industry 10 years ago. Okay, I was one of those guys that was maxed out on everything back in the day. I used to own a lot of property. And fortunately, I sold it without losing my shirt. But the problem was I had a ton of credit card debt when I sold everything. So I was just wiped out. The thing about the repair side of it is, it didn't take me that long to recover. I was in real estate. I was an investor. Once that all dried up back in 2008, 2009, by the time 2010 came around, I'd made a pretty significant pivot. I was back to doing well again. So my observation, this is just a personal observation. Like, a lot of people don't agree with me. I don't think even John Alzheimer agrees with me on this, which is perfectly fine. He and I don't agree on 100% of everything, but we love working together, and he's a good friend of mine. My case is that I believe that it's an outmoded model for people to be punished for something for 7 years. Now, granted, just what I said a second ago, especially to you, William, is that, well, it's cosmetically there for 7 years. Yes, it can have an impact. Most of the damage is within 24 months. So can you make an argument that you largely recover from this stuff in a couple of years? Yes, I think you can, provided you've built up other good credit and you've done a really good, responsible job. Okay. But at the same time, I think it's a great thing to utilize these laws, to challenge these things, and then keep your fingers crossed. A lot of, just so you understand, a lot of things that get deleted from credit reports is just because they're not verifiable. It might not necessarily mean that they're wrong, that the data furnisher is obligated to do an investigation, and they just can't pull it off. So anyway, next comment, question, Chris. Oh, David, how many of times can I dispute and or challenge items? So Credit Versio, anybody who's in this business and does it professionally and does it at a high ethical level is going to tell you you can challenge things until there's nothing left to challenge. Now, what does that mean? Well, 3, 4, maybe 5 rounds. One of the beautiful things about Credit Versio, it's one of my favorite things, is that Credit Versio can find errors on credit reports. And the more, if by the time you're at round 3, Credit Versio is looking at all the accounts on all 3 bureaus and then going back to the previous credit report and the previous credit report, you'd be amazed. Like I don't look at all the data on a daily basis like my partners do. I mean, we're a development company actually, so most of our employees, or at least half of our employees, are developers, programmers. And one of the things that amazes me is how many things go sideways when you challenge something, and then you're looking at that second, third, and fourth credit report. Things change, and they change in a way that makes it wrong. It makes it easier to dispute. That was always a really hard thing when I was with the credit repair company I was with before, because we didn't have technology. Nobody really has technology in credit repair. It's kind of embarrassing how outdated this industry is. Even people who have software, the best that the software can do is tell you what's negative and what's positive. It can't tell you if there's errors on it. I mean, that's a crediversial breakthrough right there. So seeing great factual disputes being done on accounts to get them removed or repaired is incredibly. Now, granted, I'm biased. Obviously, I work for Crediversio, but taking off my Crediversio hat and just putting on a guy that's been in this business for 10 years, I marvel at that all the time, especially when I see these dispute letters that Crediversio creates for people, and referencing the error, and then referencing the what changed from the last credit report. It's like, man, what in my old company when I had 25 people working for me, data processors, or excuse me, credit report processors overseas. All they did all day is just look at credit reports, this month and last month, and try to figure out what happened. They couldn't go like the month before to figure out what happened. People can't do that. I can't do that. I've looked at 30,000 credit reports at least, and I can't do that. Not a 40-page credit report, looking at it from last month and then the month before and then the month before to tell you what happened. Nobody can do that. I mean, not without spending a whole day, and that's just not practical. So to answer your question, Chris, Crediversio has 4 rounds of disputes baked in. Okay? Now, if you go 4 rounds, or if you get into that 5th round, and you don't see that word error in the dispute reason, if you see that, so when you select the items and you do a drop down, and it wants you to select your dispute reason, if you see error, that's a legit error. That's probably, well, when I say error, I'm not talking about something illegal. I'm just saying there's a deviation somewhere. Something went wrong. Something is very disputable based on what Crediversio sees. Now, if you're in round 5 and Crediversio is not seeing any errors, that doesn't mean you still can't dispute it. Because let's put this in context. Crediversio, the only thing Crediversio knows is what's on the credit report. It doesn't know the backstory. I mean, I can't tell you how many people I've talked to where they say, well, I wasn't late on this. I have proof. Well, Crediversio is not going to know that. How would Crediversio know that? It doesn't live in your house. It doesn't eat at your dinner table. So if you have legitimate mistakes on your credit report, then that's your dispute reason. That's why there's a selection for a custom reason right there. Put in your own reason. When people email in, they'll say, hey David, hey Travis, or whoever's doing customer support, what's the best dispute reason I should use? That's an easy answer. The best dispute reason is the one that explains why the account isn't reporting correctly. Whether that comes from you or if it comes from Crediversio. If Crediversio finds a mistake. That's the whole point, is finding mistakes. Okay, Chris, hope that answers your question. Go 4 rounds. If 4 rounds you don't see anything yourself, Crediversio doesn't find anything, that's it. Call it a day. Don't spend more money. Okay, credit repair is not a long process, by the way. It shouldn't go more than 4 or 5 rounds or so, unless there's something like a real error on the credit report, and that's a different conversation. Okay, Jamin, does the creditor or collection company have to provide the entire account history to you for it to be verified? No, they do not. All they have to do is show that they have ownership of the account. Okay, that's all that's required under the FDCPA. I had to think about it for a second. It's been a long day for me. I'm sorry. It's the Fair Debt Collection Practices Act. So you can ask, like, people get caught up into asking a bunch of crazy stuff, like, I want to see the original application with my wet signature. They don't need to show that to you. maybe the original creditor might have that, but how many times do we ever sign stuff to get approved? I mean, the credit cards I have in my wallet, I never signed anything to get those cards. The only thing that I've ever signed is my car loan and then my mortgage, and that's it. Everything else that I've ever gotten, I didn't have to physically sign anything. So Jamin, I wouldn't rely on that. Really, the hardest thing for a collection company to prove is that they own it. And the reason why that's such a problem is because collection companies buy, usually, if they're a debt buyer, they usually buy debts on spreadsheets. So they don't always get the information they're supposed to have. So just go through the normal dispute process. Credit knows how to do it if you're using Credit. If you're not using Credit and you don't want to use Credit, that's fine. You can go download dispute letters from the FTC website or the CFPB website and just use those to challenge. It's not all that complicated. Okay. Satoria, thank you. This is some great info. I hope so. I hope you're getting a lot out of it. And we are at 57 minutes. My God, that went fast. And I appreciate everybody hanging out with me. We got a little over a dozen people still watching. I'm going to wrap it up here in a second. So if you got one last question, feel free to post it, and I will certainly like to wrap up with that. There's a couple other subjects I wanted to get into today, but we didn't make it. We got good questions. We got a couple of good stories in there. So I hope that you enjoyed it. And if you're on Facebook, if you're watching a replay of this, feel free to post your question. I do see these, and I will swing back around and I'll answer it for you. Rob, moved to Texas and keep missing lives. Oh man, sorry to hear that. Well, here's the good news. It's on our website. It's going to stay on YouTube and Facebook both. So you're free to go back and watch it. They're all recorded. If you have a question though, Rob, excuse me. So Rob, if you do have a question, all you have to do is post it. I see you're watching from Facebook. Just post it. It'll alert me, and I'll swing back and I'll answer it for you. Okay, thank you so much for joining me today. I really appreciate it. I will be on again next Wednesday. Should have John Alzheimer on with me. It's always fun with John. And again, thank you so much. Take care, and I'll see you next Wednesday.